Joining us right now is Potomac Wealth Advisors founder and president, Mark Avallone. Mark, great to see you. Thanks very much for being here. What's your reaction and what do you say about this continued rally, this firmness in the market, despite all these worries about bank failures as well as a potential recession later this year?
Well, there's a couple of factors going on. In terms of this banking crisis, it's interesting. It truly is a few banks mismanaging their balance sheet. It was really foolish. They had different objectives. A perspective on what they were in business for was missing, and they really lost their way with this mismanagement of the balance sheet, which is why bank stocks haven't continued to fall. I think the market realizes this was not a systemic issue, and it was related to the rapid rise in rates in a few banks and how poorly they handled it. The other factor is investors are armed with information in this information age, and we've all gotten the memo that stocks turn before a recession ends and as the Fed ends in rate hikes. So greed is eventually replacing fear, and everybody wants to get into what they expect to be an inevitable stock rally. We just think it's a little premature for that.
Well, I mean, look at this market up in the NASDAQ year to date, almost 14%. We have the GDP out this morning. That's the final read of the fourth quarter. I know that we're expecting growth. We're expecting growth of 2.7%, but we also have the February PC index out Friday, which is going to show inflation continues to be elevated. So if we're looking at an economy that is slowing down and a macro story that has weakened, does it make sense to buy stocks right here?
Well, that's a difficult question. And investors, though, are giving you a few hints of where the rally is going to be when the Fed does end its inflation fighting cycle. And we've talked about how a slowing economy will lead to lower rates. And when the Fed starts to respond by no longer tightening monetary policy, that's going to be good for tech stocks. And again, I think investors realize that, but they're a little early. I think as we start seeing the Q1 and Q2 earnings and the impact of all this tightening and the Fed hikes and now bank lending slowdown, that's the unfortunate part about the SVB's failure is banks are going to be more cautious. I think we're going to see earnings drop. And then when the earnings slow down, that's when the stock market might realize it's gotten a little ahead of itself.
So you are expecting a sell-off then later this year?
Yes, in the near term, and we think by the end of the year, that's when the shakeout will have resolved itself. But
I see.
The Q1 and Q2 earnings are going to be a little bit of a wake-up call for investors.
Cheryl.
Well, Mark, I mean, obviously the question and the fear going into 2023 and will we or will we not have a recession was a major news event. Is the Silicon Valley Bank story, Credit Suisse, are those the news events that are going to tip us into a recession? Or do you think that we're going to, again, skirt a recession like we did last year? Not technically, but anyway, we say we skirted a recession last year.
Right. It depends on what your definition of is.
That's right.
When you relate what a recession is. I was in Europe when the Credit Suisse news broke, and it really looked like it was going to be a story that was going to bring the market back down. And really is amazing how resilient once the central banks start showing that they're supportive. So I think a financial debacle will be mitigated because these central banks are realizing they can't just keep tightening as their impacts are felt on the balance sheets of these institutions. I think the GDP number is going to show exactly what we've been talking about, a muted recovery, but not a crash. And a muted recovery can actually be good for stocks. And SVB, in an odd way, it may turn out to be good for stocks because both of those events are going to make the Fed pull back, not have such harsh rhetoric, limit the pay hikes, the rate hikes, and maybe even in 2024 begin to ease up on monetary policy.
Kevin, your thoughts. Jump in here.
You know, I think we're in the 8th inning on rate hikes. And so if you're an investor on the equity side of things and you think the terminal rate of the Fed is just under 6%, which I think is a reasonable assumption, well, there's been many decades in the past where stocks have rallied in a 6 to 7% terminal rate. We just forget that. The last 20 years we've been doing nothing except bringing rates down. I'm more bullish on equities than I am on fixed income right now. And so I haven't changed our allocations. We used to be 50-50.
Yeah.
We're now 70 equities, 30 fixed income. We're going to stay that way.
No cash.
Oh, we've been raising cash. We've been moving cash out of those little regional banks to money center banks. That's a different story. And we've been buying T-bills, 90-day rolling T-bills. But I think there's lots of opportunity in the economy. And there's something else that nobody talks about in the narrative. The pandemic changed the fundamentals of the economy towards more of a direct-to-consumer model, where margins are up about 15%. Whether you're Nike or a small business in America, you're 50% direct-to-consumer. That's a powerful new dynamic. And so we see it in our portfolio companies. I'm pretty excited about that, and nobody talks about it. Pandemic had a silver lining, and that was it. Yeah,
Mark, real quick before you go, you said it's a little early for this rally. Does that mean you're selling into it, or are you buying stocks? How are you allocating capital?
We're not selling current positions, but we're very cautious with adding. And I think it's the areas of the market that have been beaten down the most that could offer opportunity. I mean, bank multiples are really pricing in a doomsday, and we think they may be a little oversold. And we've never stopped liking technology.
Mark, it's great to have you this morning. Thanks so much for weighing in. Mark Avallone, we will see you soon. Thank you, sir.